$65 billion. That was the number printed on the account statements, the paper fortune that thousands of people believed they owned. None of it was real. In December of 2008, in his Manhattan penthouse, Bernard Madoff sat his two sons down and told them the truth. The investment business he'd run for decades was, in his words, a giant Ponzi scheme. No real trades, no real portfolio, just income and money paying out earlier investors, year after year. Here's the question that should keep you up at night. How does a firm execute essentially no genuine trades for more than a decade, and nobody with the power to stop it ever checks? Because someone did check. Someone proved it was impossible, with math, years before the collapse. And he was ignored. To understand how, you have to go back to the man everyone trusted. Bernard Madoff was not a fly-by-night hustler. He was Wall Street royalty. He founded his firm, Bernard L. Madoff Investment Securities, in 1960 with around $5,000. Over the years, he built it into something genuinely impressive, a technologically advanced market-making operation that helped pioneer the electronic trading that powers modern markets. He even helped popularize a practice called payment for order flow, the same mechanism that brokers like Robinhood would use generations later. He had an office in the famous Lipstick Building. He had a reputation for steadiness, exclusivity, and quiet brilliance. And that's the cruel part. The legitimate side of his firm was real, sophisticated, respected, and it gave perfect cover to the other side. Because alongside the trading desk sat a separate investment advisory business. That's where the lie lived. To get in, you needed an introduction. Madoff often acted reluctant to take your money, which only made people want in more. Trust was the product, and the trust was built on numbers that were, frankly, too good to be true. Here was Madoff's pitch. Steady, modest, dependable gains almost every single month, in good markets and bad. If you plotted his reported returns on a chart, you didn't get the jagged peaks and valleys of real investing. You got a near-perfect line, climbing at roughly 45 degrees. Smooth, calm, almost serene. Over 17 years, across the dot-com crash and other major shocks, his advisory accounts reported only a handful of losing months. Around seven down months in 17 years. That doesn't happen. Markets don't behave that way. Real strategies have bad streaks. Madoff explained his magic with something called a split strike conversion, buying a basket of large stocks, then using options to cap the downside and trim the upside. It sounds technical. It sounds plausible. And to a layperson, it explained the smoothness. But to anyone who actually ran the numbers, the explanation didn't add up. It explained nothing. One man decided to run the numbers. His name was Harry Markopolos. He was an independent fraud investigator and options expert, and he set out to analyze how Madoff produced those beautiful, steady returns. So Markopolos sat down with the math, and almost immediately, something was wrong. The split strike strategy Madoff described simply could not produce the results Madoff claimed. The returns were too consistent, the down months too rare, the whole curve too clean. Markopolos later said it took him minutes to suspect a fraud, and not much longer to become certain. There was a deeper problem too. For the strategy to work at Madoff's scale, he'd need to trade more options than actually existed in the entire market. The volume wasn't just unlikely, it was impossible. Markopolos concluded there were only two explanations. Either Madoff was front-running his own brokerage customers, or the whole advisory business was a Ponzi scheme. He came to believe it was the latter, so he did what you're supposed to do. He took his proof to the regulators. And here's the tease that defines this entire story. He was right, and it still ran for nearly 9 more years. Markopolos didn't warn the Securities and Exchange Commission once. He warned them again and again. He brought concerns to the SEC around the year 2000, and again in 2001. Then, in 2005, he submitted a detailed memo with a title that left nothing to interpretation. The world's largest hedge fund is a fraud. Inside, he laid out red flag after red flag, the impossible consistency, the options market math that couldn't be true, the secrecy. He practically handed them a map. And he wasn't alone. Back in May of 2001, journalist Michael Okrant, writing for Marhedge, and Erin Arvidlund, writing for Barron's, both published pieces openly questioning how Madoff produced such impossibly steady returns. The warnings were out there, in print, for anyone paying attention. So why didn't it stop? Because the most basic verification step was never taken. To check whether Madoff's trades were real, an investigator only had to contact the depository trust company, the central clearinghouse, and ask whether the trades on his statements actually existed. Nobody did. The SEC's own Inspector General later found the agency never properly examined or investigated Madoff, despite numerous credible complaints. The proof was sitting on a desk. No one made the phone call. And while regulators looked away, the machine behind the lie kept humming. So how do you fake billions of dollars of trading? You build a factory for it. On the 17th floor of the Lipstick Building, separated from the legitimate business upstairs, sat the engine of the fraud, known internally as House 17. At its center was an isolated IBM AS400 computer, deliberately walled off, that generated the illusion. Running the operation day to day was Madoff's chief lieutenant, Frank DiPascali, who would later admit simply, it was all fake. The team didn't pick stocks. They picked results. They'd decide in advance what a return should be, say up 1% for the month, and then work backwards, fabricating trades, complete with backdated prices, to justify the number. According to prosecutors, two computer programmers, Jerome O'Hara and George Perez, built the software that mass-produced the fakes, programs whose file names were prefixed SPCL for special. The system churned out thousands of phony trade confirmations, statements, and clearinghouse reports. There was even a random number generator to make the timestamps look realistic, and a phantom trading platform ready to fool surprise inspections. The firm kept two sets of books, one to show regulators, one closer to the truth, and every dollar from investors. It didn't get invested. It flowed into a single JPMorgan Chase bank account, and withdrawals were paid right back out of that same pool, which is exactly why the whole thing had a fatal weakness. A Ponzi scheme only survives as long as new money coming in covers the money going out. Stop the inflow, or spike the outflow, and it dies. In 2008, both happened at once. The financial crisis hit, markets cratered, investors everywhere needed cash, and they came to Madoff to get it. By November, investors had pulled out billions, and as the panic deepened, redemption requests piled up faster than the account could pay them. The pool was draining, and there was no real portfolio to sell, because there had never been one. Madoff knew the end had come. In early December of 2008, he confessed, first to his brother Peter, then to his sons, Mark and Andrew, who worked at the firm on the legitimate trading side. He told them the advisory business was, as he put it, a giant Ponzi scheme worth nothing. His sons did not protect him. That same night, they reported their own father to federal authorities. On December 11th, 2008, Madoff was arrested at his penthouse. The SEC filed suit, alleging a fraud of around $50 billion. The largest investment fraud in history was finally exposed. But exposure was only the beginning of the damage. The legal reckoning came fast. In March of 2009, Madoff pleaded guilty to 11 felony counts: securities fraud, wire fraud, money laundering, perjury, and more. He took no plea deal. He was remanded straight into custody. On June 29, 2009, Judge Denny Chin sentenced him to 150 years in prison, calling the crimes extraordinarily evil. A criminal forfeiture order of roughly $170 billion was entered against him, a figure reflecting the total funds that had flowed through the fraud over the years. But the courtroom numbers can't capture the human cost. The collapse carried a devastating human toll. A feeder fund manager, Thierry Magon de la Villouche, and 2 years later, Madoff's son Mark, both died by suicide. His son Andrew, who had helped turn his father in, died of cancer in 2014. And Madoff did not face the law alone. 14 people were ultimately charged. His brother Peter was sentenced to 10 years. Frank DePascali pleaded guilty and cooperated, but died of cancer before he could be sentenced. In 2014, after a months-long trial, 5 former employees were convicted on all counts. The man who built the lie died in federal custody in April of 2021 at age 82. But for the victims, the story didn't end with prison sentences. It ended with an extraordinary, decade-long recovery. Here's the part that surprises almost everyone. With Ponzi schemes, victims usually get pennies on the dollar. Madoff's victims got far more. The key was a court-appointed trustee named Irving Picard, who pursued an aggressive strategy: clawbacks. The logic is simple but powerful. If the money was never real, then anyone who withdrew more than they put in had effectively profited from other victims' losses, and that money could be recovered. Picard sued, settled and pressed for years. He recovered roughly $14.8 billion. The single largest recovery came from the estate of investor Jeffrey Pikawa, which returned a staggering $7.2 billion. On top of that, the Department of Justice ran a separate Madoff victim fund, which distributed more than $4.3 billion to over 40,000 victims around the world. In December of 2024, the DOJ announced its 10th and final distribution. Add it all up, and victims recovered roughly 94% of their recognized principal losses. For a fraud this size, that's almost unheard of. And yet, the deepest lesson here isn't about the recovery. It's about why nobody stopped it in the first place. Go back to the very thing that made Madoff so attractive, that smooth, steady, ever-rising line. Investors saw it as proof of genius. It was actually the single clearest sign of fraud. Real returns are bumpy. Real markets punish everyone sometimes. So when results look too consistent, gains that never seem to suffer through a crash, that smoothness isn't a virtue. It's a warning. The second lesson is about verification. The fraud survived for years, not because it was undetectable, but because almost no one independently checked. A whistleblower handed regulators a mathematical roadmap, and the basic step, calling the clearinghouse to confirm the trades existed, was never taken. The pattern is worth remembering. Independent third-party custody matters, because an outside party actually holding and verifying the assets is what makes a fraud like this far harder to run. Secrecy, exclusivity, and a tiny unknown auditor signing off on billions are the kinds of red flags that went unexamined here. And understand the fraudster's real tools. Madoff didn't win with sophisticated trades. He won with trust, with reputation, with status, with the sense that you were lucky to be let in. Affinity and reputation aren't proof of honesty. In the wrong hands, they're the disguise. The man who proved all of this in minutes spent nearly a decade shouting into the void. The math was never the hard part. Getting anyone to listen was.